Bitcoin is about to have its biggest day since September. Meanwhile, stocks are chopping sideways and the dollar is up, and we just missed expectations of the CPI. So what does that mean for the rest of this bear market rally? Are we going to start dumping and heading to the lows where everyone is calling for, or are we about to have another 100% gain similar to what we've seen in previous bear market rallies? Well, in this video, I'm going to cover all of that and much more and go over some really key statistics that you need to know before investing, because if you don't, I'm telling you, you are going to get your head chopped off. These are things that people overlook because they get caught up in the moment and then they find themselves buying the top and selling the bottom. So let's go ahead and jump in. Bitcoin just faked everyone out once again. As we have mentioned many times in these bear market rallies, very similar to what we saw in 2018, we see the same type of price movements. We see it trading higher highs, higher lows, big fake out to the downside, and then you see it push higher. Same thing here, big fake out. And once everyone's calling, hey, there's divergence, hey, this is a sucker's rally, hey, blah, 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 blah. When you are in a massive bear market rally after the entire year to the downside, which we have covered time and time again, it literally timed it to the exact day from the top to the bottom, the exact same time frame in 2015, 2018, and now once again in 2023. And we've been saying once we have this massive move after that year bear market rally and you see volume pick up, a lot of technicals do not make sense anymore because these bear market rallies are pretty much like an X factor where you can pretty much throw out the majority of the TA that you have learned. So just watch everyone on Twitter get everything wrong this entire rally into March, and then you'll see that actually dump, and then they will probably delete their account like Michael Burry. We've talked about this previously, these longer cycles. This is Bitcoin all the way back to 2011, okay? What we look for, I covered these three indicators that really tell you when you're actually coming out of the bear market rally, and it's still not confirmed yet. And I'll show you some other moving averages here in a second that you can also get confirmation. But I'm looking at the CCI, RSI, and stochastic RSI. So these three things on a 2-week time frame, just looking at Bitcoin. And what I look for is I look for that low in the RSI that's trading very low to the 30. I look for the CCI trading to -100. And then I see that these things are starting to trend upward. So it's more of like a divergence where price is going sideways and or down, and this indicator is going up. Same thing with the RSI. Bottoms, it's trending upwards. And then same thing with the stochastic, it's trending upwards. And what I want to see for confirmation of when these rallies occur, you'll see in 2015, we saw the low actually here, but this move was actually really big. It faked a ton of people out, and then we came back down to almost close to the bottom of this body of the candle. We didn't head to new lows, but we did have a massive fake out. And this was a big deal in the moment. I actually bought Bitcoin back in 2013. And I do remember some of the time frames around this area and what the overall sentiment and what my thought process was. I'm like, hey, we're heading to new lows. And what do you know? We ripped, thousands of percents higher. So what I look for confirmation is I want to see the stochastic RSI trading above this range at 80. Okay. I also want to see the RSI confirm above the middle line here, which is at 50. And then I wanted to see the CCI trade above into a positive range, which is really above 0. Once I see all those things, I do have confirmation that we have 100% had the lows in, which obviously nothing is ever 100% in trading and investing, but a very strong confidence that we are heading out of that bear market low and likely to head into quite an explosive move. So all three of those things happen there. Once again, in 2018, you see the same thing. The CCI trade all the way down here, it trends upwards. You see it in the positive region. You see the RSI come above the 50, and then you see the stochastic above the 80. And all three of those things, guess what? They happened right at this massive rally. And if you were to zoom in on like a daily chart in 2018, you would see that it looks very similar to where we're at today. Again, you see the big U-shaped recovery. You saw those indicators. Then you see it trading higher highs, higher lows up here. And then you see a big fake out to the downside, a little bit of sideways action, section, and then it just trends upwards and upwards and upwards, right? And again, that was a 340% rally from this low to the high here. So these are not small moves. These are really, really big moves, okay? Now let's look where we're at right now on these longer term indicators, where we're at with this low. Well, CCI has definitely had bullish divergence that entire time. Same thing with the RSI, trending upwards. RSI is almost above the 50 here, okay? It is getting quite close. And it probably will be if Bitcoin keeps trending upwards into the weekend, to end this weekend into the weekend. CCI is starting to approach that positive line here. We had a really, really big move. And this, I look at BLX, which is Brave New Coin. It's a liquid index for Bitcoin, so you can actually look over a long period of time. And that is not factored in the actual price of Bitcoin. And we're looking at Bitcoin right now trading at 22,000. If you look over here, Bitcoin is actually trading at 24,000. So these indicators could actually be over that section that we're talking about. And stochastic is definitely above the 80. So we have confirmation on the stochastic. I think the RSI is probably already there. We'll actually go check right here. RSI is itching very, very close to that 50 level. It'll probably be there either tonight or tomorrow. And CCI is getting close as well. CCI can move actually really, really quickly. So, and if you look once again on the daily chart, you see this, right? We see the big U shape right here. Okay, we see it trading higher highs, higher lows, fake outs, fake out, and bam, really, really strong green candle. This is the strongest green candle that we've seen since September. So today is nothing to blink an eye at. It is definitely really positive for the potential price of Bitcoin to see a candle this strong. When you see this body of this candle that strong, and you see that much buying pressure come out of nowhere, that should give you a pretty good sign that it's likely going to continue the rally. All right. Dollar is now trading upwards. So it's actually really good to see these things trading opposite of each other, because typically when or actually in tandem with each other, usually they're trading inverse to each other. So when the dollar goes up, the dollar gains strength. Bitcoin has typically fallen downwards, but now we're seeing the dollar rally right now, and Bitcoin is actually trading up, which is a really positive sign that we're starting to see that disconnect a little bit, because the conviction in the price of Bitcoin going up is obviously very strong. Once again, we've been talking about this on stocks. So this is the S&P 500, once again traded outside of this broadening descending wedge. So you see how we get this range is kind of trading higher and higher and higher, and then it finally cleanly broke above this range. It looks like we had a little bit of a bull flag and now starting to head upwards once again. And we had a really strong end to today. And I do believe that stocks are going to continue to rally. And I'm not sure if we're going to see all-time highs this year, but if you have listened to our previous videos, we've talked about there has never been a time after midterms in a 12-month period of time where we actually had a negative return for the stock market. So I am expecting this to continue to rally as everyone is projecting in a Fed pivot. And if we're going to cover something really, really key here in a second about the Fed pivot, but we did see inflation actually come down once again, which is a positive sign that we're seeing inflation come down, because the Fed is going to continue to hold rates high and or hike rates until inflation comes close to their target of 2%. But at least it is coming down. It did not meet expectations. So we did see a little bit of bearish price action after we missed expectations, but now it is still once again in that trend on a downward slope, which is positive. Now remember, we talk about this. We've talked about this picture that we've mentioned many, many times. I believe it's from whoever the heck this is in the bottom right-hand corner. Lead. So shout out Lead Habahuaha. And what this shows you is when the Fed actually pivots, which is these purple triangles. So this is the federal funds rate at the top. This is the S&P 500 drawdown at the bottom. It doesn't happen every single time, but the majority of the time, 80-90% of the time, after the Fed pivots, what happens? You see the big drawdown, guys. Look, after the purple, Nurple. We had a miss right here. We had the purple Nurple, huge drawdown. Once again, huge drawdown. We had a miss here. And then if we look at more recent times, and these were big drawdowns as well after the Fed pivot here. But if we look back in In 2008, massive, or in 2000, massive drawdown in the S&P. Once again, after the Fed pivot. In 2008, same thing. After the Fed pivot, massive drawdown in the stock market. And the reason why is, guys, because these things take time to play out. When the Fed hikes rates and holds rates high for an extended amount of time, that liquidity crunch takes time for the ripple effect to play out and actually damage financial markets and earnings and companies. So it takes time for this to happen, but markets price in future price action. So what is happening right now? The reason why we're seeing this rally is because the Fed is saying, hey, we're slowing the rate hikes down, guys. We're moving from 75 to 50 to 25. So everyone's like, oh, the Fed's about to pivot. So what are they doing? They're pricing in the pivot right now. And then once the pivot actually comes, it's going to be too late for markets to recover. And I do think that we are going to see a sell-off after that occurs. But again, we got to take it one step at a time. And anytime there's new data, we've got to be open to making new decisions and formulating a new thesis. That's how investing works. There's a lot of negative things right now. I don't want you guys to think, some people watch my channel, they don't understand the full context of what I'm thinking. I am thinking rally, then actually a pretty big sell-off. Okay, so I'm actually bullish short term and bearish kind of, midterm, maybe 9 to 15 months later. And if we look at, M2 is actually shrinking. So the liquidity crunch is real. And we're seeing that it's shrinking at a very, very fast rate. So that is not good for equities and assets, because when liquidity is getting pulled out of the market, that does not help prices going up. This is me on Twitter, by the way. If you haven't followed me on Twitter, go follow me. I'm almost at 10K followers. When I post this type of stuff all the time, just post another thread today. And we've also seen the deepest inversion in decades. If you look at the inversion curve, this predicts recessions. So when you see deep inversions like this, guys, you can see after this inversion, recession. In 01, once again in 08, huge recession with the inversion coming before it. Once again before COVID, inversion, recession. Right now, we have a really deep inversion, actually the deepest inversion in a very, very long time. If we look at, other things with consumers, looking at consumer spending, looking at issues with them being able to, 40% having trouble paying their bills and auto delinquencies rising, which is beyond the levels and the Great Recession. Overall, consumers spending and statistics don't look good. If you look at personal savings rates, they have come way, way, way down, guys, since even lower than where they were in 2008. We're starting to see that trend upwards. Let's hope that starts to trend upwards, but really, really low savings rates. And what is also really not good is the inversion of this, where you see saving rates going way, way down, and then you see the consumer loans going way, way up. So during COVID, we had the savings go way up because they just printed a bunch of money and handed out a bunch of money, and then you saw the debt go down because people were paying off their debt. But now it's the vice versa. Okay, now we have a lot of debt where we've got consumers getting further and further in debt. And a lot of this is credit card loans, which is ultra high interest. So when people don't understand how credit cards work and they take out debt, that's one of the most key things you got to do. Debt is really, really powerful, and it can be very good if you use it the right way. But you have to know what you're doing, and most consumers do not know what they're doing. They are not educated on how debt works. So seeing this climb and seeing the savings rates go down is definitely not a super bullish thing to see, because eventually, consumers ultimately determine financial markets. If the consumers are in a really, really tough spot for an extended amount of time where you've got high inflation, low savings, and high debt, eventually that is going to catch up to asset prices. So everything can't stay afloat for forever, but oftentimes things do stay higher and feel a little bit irrational longer than you will believe. We may see a rally a lot higher than you actually think and anyone actually thinks. And things can actually behave irrationally longer than people believe. So it's important to start thinking like an investor. Start thinking about, hey, how are people going to be pricing in? If we're thinking about the data 6, 12, 18 months ahead of time, how are smart investors going to be pricing that in now and putting capital in certain places? And how can I put money there before the rest of everyone else does. And I can tell you a lot of retail, guess what they're going to be doing? They're going to be buying the tops, guys. They're going to be buying the tops after the Fed pivots. And what is going to happen? They are going to get wrecked. All right. So I'm telling you, that's what I believe is going to happen. I'd love to hear your personal opinion down below. Again, we're taking things one day at a time, and I'm going to shoot another video about this. But the X factor right now is the wars overseas. Things are starting to pick up. There's talks about nuclear, weapons being onboarded onto ships over in Russia, and it's not looking like things are heading in the right direction. So that would definitely be the X factor. If a war happens, if you guys go look at what happened, at least with like 9/11. You will see markets, if we go into World War III, you will see markets sell off extremely fast. They will probably be hitting circuit breakers depending on how, emotional the news and media makes everything sound online. But you will absolutely see a big sell-off in financial markets if we go into a war. Then what happens, guys? It's going to fake everyone out once again. Then what do? How do you pay for the wars? Let's just turn on the money printer once again. You will see markets sell way off. The money printer will come back on, and then asset prices will rip higher. Okay, once there's a sentiment around the war is starting to get a little bit better, and we've been printing money for an extended amount of time to try to pay for the war, then you will see the markets rip higher, and again, that'll fake everyone out. So that is the X factor. We will cover that more in one of the next videos. Again, thank you so much for watching. I do want to shout out, we got the Federal Reserve. They print money. Why can we not print money? Why don't we print money as well? That's what we do as well. We build an algorithm called the Fed that is currently doing 22.8% per month. You can see today it is already up 0.63%, $1,200. This week it is up 2.27%. This month is already up 26K. It's only February 15th, so a little bit halfway past the month mark. And then this year it's up 41%, $71,000. If you want some information on potentially licensing this software, this is not our average return for our clients. This is not, a future estimated returns, because obviously nothing is guaranteed. We don't control financial markets. I just help use algorithms to help my portfolio be a little bit more automated. I don't need to stare at charts all day like a monkey. Okay, I do stare at charts quite a lot, but I do like to use some automations. Why would you not program certain things when XYZ indicators hit in order to enter and exit trades? It's what the largest and most successful funds do. Just go ahead and look up Jim Simons, that runs the most successful hedge fund of all time, averaging over 60% per year over the last 10 years. All right. Thanks so much for watching. See you in this next video.